example, we Group 1 would like to present our fundamental valuation analysis of Ingredient Incorporates, a global leader in the ingredient solution. This presentation is a result of our group collaborative effort. Let's begin with the introduction to the company. Ingredient was founded over a century here and has grown into a major player in the agriculture business sectors. Their core products include starch and sweetener with a high fructose corn syrup, bringing a key ingredient. They serve a diverse range of essential industries, from food and beverage to paper making. It's important to note that they operate in highly competitive global markets, which make a robust financial analysis crucial for their understanding their value. The next is we'll talk about the data and methodology. For our analysis, we rely on two primary data sources: Ingredient own 2024 annual report for the foundational financial statement and Yahoo Finance for the current market data. Our chosen valuation method was two-stage discount cash flow or DCF model. This involved forecasting the company's free cash flow for 5 years period from 2005 to 2009, which allow us to capture its near to mid-term growth trajectory.
I will continue the presentation. That is our valuation result. Number one is free cash flow to the firm, which is FCFF. In our case, it comes $1,089.3 million, which the Ingredient Corporation has generated as a free cash flow after deducting all the expenses, and it shows the how firm is able to generate the cash from the operation in order to pay the other expenses like debt, taxes, and other marketing expenses and reinvestment. And number two is WACC, weighted average cost of capital. In our case, it comes 6.54%, which reflect the rate of companies average rate of company that must pay to the finance, and it act as a discount rate for future cash flow, and it ensures the value of the value we estimate for the cost of financing and risks. And number three, that is a growth rate, where it for long-term growth rate is projected at 2.5%, representing the steady increasing in the cash flow after focusing period. And now the terminal value for the Ingredient Corporation, it is $216,513 million. It captures the present value of all the cash flow beyond the explicit focus period, and a large portion of enterprise value, highlighting the importance of long-term growth and assumption in the valuation. Now the enterprise value for our company, it is 200,000, 4,415 million, with solely attribute to the shareholder after subtracting the net debt from the enterprise value. Now next slide, we have a pro forma income statement where the net sale we projected is 7,734 million in 2020 to 8,452 million in 2029, which is a high growth, indicates that the company Ingredient is extremely performing good. And next is gross profit margin. It's stable indicate that it consistent efficiency in producing goods and services, and we projected it to of 24.5%, and the net income we projected is 700,000 million in 2029, driven by the revenue growth and the control costs, and the operating expenses are consistently maintained at 11.5% of revenue, highlighting there is effective management of costs. Now the pro forma balance sheet. The total asset increase consistently towards 2029, showing that the company is reinvesting in the operation and expanding its capacity, and the liability remain stable as a portion of asset, reflecting there is a control of borrowing and the financial stable. And now the shareholder equity, there is a strong growing in the shareholder equity. It improved the profitability and return earnings, showing the firm is creating a value of share and maintaining the healthy financial structure.
So I'll be continuing the presentation. So I'll go through the discussion and interpretation. So what does all the results we get mean? So we will interpret the results as follows. So first, Ingredient company will demonstrate strong cash flow and capital efficiency as evidenced by its low debt ratio, which is amounting and growing FCFF. So combining this with our intrinsic value of $140 against the current market price of around $115, so this makes the stock appears to be undervalued. So therefore, while the outlook of the company is stable and positive, it remains essential for investors to monitor the company's ability to maintain its profit margin and the company's growth target. So next slide. Next slide is conclusion and recommendation. So to conclude our comprehensive DCF analysis, it indicates that Ingredient Incorporated is financially strong and its shares are currently trading below their intrinsic value. So based on this recommendation, we can say that it is definitely a buy situation for the investors. So we believe that investors should focus on the company's execution of its growth strategy and its cost control initiatives.